Well, guys, you know me. I like to hop right to it and not waste a lot of time. And there has been a lot of changes since the last update. The market is going through a lot of crazy stuff, and there's a lot to talk about. But there is a big update that I have for you that I'm going to talk about first. So tomorrow, Saturday, July 23rd, Twitter Spaces. I'm going to have a link down below so you can check it out. But we're going to have Don Durrett on. A lot of you guys in the gold and silver space already know him. He's a big name in the space. He's an author. He publishes a very successful newsletter. He's well known for his 10 baggers and all of his due diligence and his research. We're going to have him on as a special guest on the Precious Metals Twitter space tomorrow. Link will be down below. Please join. Set your reminder so you don't forget. It'd be great to have you live. And if you have any questions you'd like Don to answer or me to ask, type them down below in the chat, and I'll read them, and I'll consider the best questions to ask, okay? So this is kind of my way to help you guys get involved if you don't want to come on and just ask the questions yourself. But that's one of the great things about the Twitter Spaces is that you can be there and just be a part of the conversation. So I really encourage you to be there. Again, the link will be down below. Now, that being said, let's get down to it. Look, I don't like being wrong. Nobody likes being wrong. But the emotion that I feel from being wrong isn't even remotely as close to the emotion that I feel when I'm right, which is just to say that as much as I hate being wrong, I like being right a lot more, okay? And so that means that I'm willing to change my mind if I need to, if the situation changes in order to be right. Now, do I think I'm wrong? Not exactly, but things are kind of changing. We're going to get into that and explain why. So as many of you know, especially the long-time subscribers of the channel, understanding the bond market and what's happening here has been a primary component of our success to this point because we understand and have understood how this has been impacting the market. Well, you can see the pattern that's playing out, can't you? I mean, this is clearly a head and shoulders that's developing on the 10-year. All right, and this is telling you that it's getting ready to break down. And you can measure the move. It's at least going to come down here to this 200, right? Which is in and of itself quite substantial, 2.4. Listen, the market's telling you what we have been predicting since the foundation of this channel, which was that the Fed was all talk and no bite. Of course, that wasn't so much of a prediction as it was just understanding the math of the economic situation. And not to get back into all of that, but this was a very easy call to predict, okay? We knew that this was going to be very meaningful once we got up here, but ultimately at the end of the day, it was going to roll over. Okay, because the Fed was always going to capitulate. Now, has the Fed capitulated yet? No. But the market is sniffing it out. The market is catching up to us. And so what does this mean? Well, it means several things. It means that the trading dynamic is going to start changing here. And it's going to start impacting our commodity trades a bit. And so where do we start? Well, first of all, we're going to start with uranium, all right? And these are some notes from some charts that I had published on Twitter for you guys to help you stay abreast of the situation while I was out of town. Listen, nothing has changed here. Until Cameco loses this pivot at $20, nothing has changed. However, it is getting long in the tooth, and it is starting to show some signs of struggling. All right, some signs of weakness. Now, I've been pointing out for a while that this declining volume on this kind of sideways action was typical of consolidations before a big breakout. Okay, so what you kind of have is a sideways pattern, all right? Kind of trading sideways. Let's use this instead. You're trading sideways like this as the volume is declining. This is a classic setup for a big volume break and then a big directional move on that volume, okay? It can break up or down. Now, obviously, we have positioned on this channel in a way anticipating this move for an upwards break, okay? And technically, that is still in play because even the sell-off today was still not an acceleration of volume. Nothing has really changed. It's simply staying in this range, really trading sideways. What it did here was it kind of gave a peekaboo. It faked a lot of people out, and it gave a false signal of a breakout on no volume, and that lack of volume breaking out was your sign that that wasn't the case. Like that wasn't a true breakout, that was a fake out. And that's kind of a bad thing because typically when you do these little peekaboos like that and you fail, you're probably going to come back down here. All right, you just probably are. The reason why that's bad is because we're going to test this floor again, one more time. And you got to understand that the more you test this floor, the weaker it gets, the weaker it gets, the weaker it gets, until it finally breaks. If you put this on the backdrop of the situation, what's happening broadly, this could be a portend of the future, kind of signaling that look out below. All right. The thing is that until that happens, nothing has changed. And the market's really testing the mettle of both the bulls and the bears. If you're a bull, then moves like this whole thing right here, and even this breakup up here, you were, celebrating and, mocking bears and stuff. But if you're a bear, then seeing this fail is validating you. You're saying, see, I told you this is not breaking out. We're just going sideways or whatever until we break lower. The thing about it is everybody's being vindicated in what they think. The market is giving everyone what they want to see. The market is showing you your inherent bias that you have at every stage, okay? And really what that's actually doing is it's shaking the tree constantly. So the people who can't sit still, either out of the trade or in the trade, are just being shaken all around and they're losing all their money. Okay, but the people who are remaining still, like us who bought down here on these trends, okay, we're not losing anything. In fact, we're up. But the people who are kind of getting shaken around, oh, it's falling over, or oh, it's going up, whatever, these people are just getting tossed around. I just want to reiterate here that until you get a break of these levels, then this setup is still good. And we are still technically holding this trend. In fact, if we zoom out on a weekly, all right, this hidden continuation divergence is still playing out. This is a signal right here. These diverging lines on the bottom of the price action. What this is telling you is that this upward trend is priced to continue. Okay, so as the price goes up and up and up, the RSI cools. Okay, and so it's cooling down, gaining energy for another ramp up. That's basically how you can think about it. So, there are still all these signals that say, look, this is in play. But if you look at this weekly close that we just got, this is an ugly candle. This is not a very good candle. Not only did we fail to close above the 50 on the weekly, but it's got a lot of wick in the wrong direction. So again, the market is giving everyone what they want to see. Again, declining volume, even on the weekly. It's very ambiguous right now. And so my advice is to just remain patient. Don't get caught up in all this day-to-day action. Both sides are getting massive movements. I mean, look today. You had a 6% down move in a day. Just a few days ago, you got an 8% move up in a day. And it's just going back and forth, back and forth. And if you're watching this market too much, you're going to get tossed around like a ship at sea. And, the market's going to win. The casino is going to win because house rules are going to win over your emotions. But I will urge and caution you that, as we had the imminent cross here of the 50 and the 200, it failed to hold. And so it looks like it's going to get the death cross right here, okay? And that's not necessarily good either. That's a bad thing too. So this is all a very long-winded way to say that the situation might be changing. I mean, it could be starting to look a little rough. We have the same setup here in UEC as we do in Cameco and NXC. They're all showing the declining volume on what's essentially sideways trading action, okay? Coming to an apex and the need to break out. Now, I had charted this little line here earlier in the day when the price was still up here, and you'll see that that's where it closed. So on a short-term time frame, this little support held, but it closed at the bottom of the candle. And so it's like there's two ways to look at that again, too. Coming over to NXE, again, this is traded sideways the most clearly, right? It's got the same setup in the volume. Everything's the same. You're seeing confluence in the setups broadly, okay? All the setups are looking the same. In the case of NXE, you did get a bit of a breakup today in volume, okay? And it was somewhat of a momentum shift down. But again, until you break 350, it doesn't matter. So I feel like I'm going in circles with this thing, but you have several descending wedges on some of the smaller names. So look at uranium fuels. Descending wedge, it's primed for a break, failed to break here. You had a double confluence of the top resistance slope in addition to the 50 on the daily, okay? Fail, peekaboo and fail. Again, not good. You have two potential supports down here for it to catch, all right? But typically, these failed moves are not a good sign, all right? It's just like how we've been predicting the big play on how to swing this. If we got this double bottom here, what we were going to do, remember? We were going to come and see what happened at this level. Because if it failed and rolled over, we were going to get out and sell, right? Because it would be a failed move. Well, that's kind of what's happening in some of these stocks. You're getting a failed breakout here. Same thing, Global Atomic. You're getting a failed breakout here. And that's not good. It's not good. But at the same time, you have quite a bit of ways to fall before you catch support and even risk breaking this potential move. So that's another 15% down to come down and just hit support. Is that in your risk tolerance to risk another 15% to the downside to try to retest this support? That's up to you. I will tell you that I'm going to hold through this and see what happens, okay? I'm going to hold to see what shakes out or until I see more info. Part of the reason I haven't been making as many videos is because I've been traveling so much. I've been out of town all over the country, and I'm just curious if I'm a little out of sync with the markets because I can't look at the charts every day all the time like I had been in the past. So is my deteriorating confidence because of what I see in the charts, like I'm explaining to you right now, or is it because I'm a little out of sync with the markets and I lack the confidence to just say, hey, look, it's all still on track? I'm not sure yet, but I promise to figure that out soon. So with that being said, in the case of uranium, look, nothing has technically changed. This whole setup is the exact same. And we are neither right nor wrong on this call, on this accumulation that we've been doing here. Remember, we called the sell-off back here. We called this buy zone up here at the start of the sell-off. We called this pivot trade right here as soon as this started. We called the sell here. And then once we started rolling over, we said, look, we're going to get the double bottom, right? Which we've had this action right here. So we have called uranium, I dare say, better than anyone at this point. Far and away. I haven't seen anyone do anything close to what we've done. And very specific calls with specific price points, with specific price action. I'm very proud of what we've done to this point. But this one's getting shaky. It's getting dicey. I don't know if we're going to get it anymore. It's just a watch and see. I can tell you that my confidence is beginning to wane in uranium. We'll see what that means. But with that being said, remember, I had the same sentiment about right here before that sell-off. As I knew that sell-off was coming, and right about the time I started to crack, we got it. All right. So, again, what you're waiting for, just to sum this all up, is the break on this volume, okay? When that comes, when that volume breaks out, something like this, okay? Whichever direction the price moves, that's where it's going. And you can take that as your sign, your clue to either get in or buy or whatever it is you want to do. All right, that's your clue. That's how it's going to end. I'm going to turn over to gold and silver. We're going to start with First Majestic. This is a zoomed out, long-term, big picture, weekly view of First Majestic. Now, I want to illustrate something to you. These charts I've been publishing on Twitter as a way to help you guys stay up to date while I can't publish videos. So, by the way, if you're looking forward to my videos and you're not getting them because I've been working, then you can always get on Twitter. I try to keep you guys updated there. Here's what you need to see. Look, we are the most oversold since 2020, all right? And 2020 was the most oversold since back here, which, of course, was right before an imminent and massive bounce on this huge bull run back here that started in 2015. All right. All indications say that we are due for an absolutely euphoric, meteoric bounce in the gold and silver space. And what we're looking at right here, we're going to find across the sector and everything we look at today. If you look at the breadth, which is to say the distance. All right. So this indicator down here, it tells you the distance the price is from the blue line, which is the 200 moving average, all right? So on the weekly chart, which is a big picture, we are the furthest away, which is to say the most oversold since way back here when that last epic run started, which ran up, 700% in 30 weeks. It's something to keep in mind. All right. Again, similar story back here, similar story here, similar story here. And, it's the same thing everywhere we look. We look at EXK, Endeavor. You have to go all the way back to 2020 to find the same kind of oversold breadth. All right. Even though the RSI is up higher, EXK is holding up quite well. Let's continue to go down. Fortuna Silver Mines. Again, look at the breadth. It goes all the way back to 2020 to get this oversold. Okay. You see the ascending RSI here. The RSI is going up as the price is going down. All right. This is a bullish divergence. Okay. This is telling you that a reversal is coming, and it's coming as we hit key critical support that has always stood up quite significantly in the past. All right, moving on. Looking at Hecla, it's a really fun chart. Again, it shows a lot of confluence with being, just very technically oversold. These oversold levels match up historically with other levels that were very oversold that led to strong rallies. And look, the most confluence that I'm seeing in all these charts has to do with the oversold levels, some of which you have to go back to 2014 to find confluence with, okay? Look at the case of MAG here. It had pretty strong support right around 1150, and that's right about where it is right now. Again, you have to go back to 2020 or 2018, 2019 to find these oversold levels, which again led to major bounces. The technicals are there, right? All the technicals are here showing you just how oversold we are, okay? I mean, you get to levels this low on the technicals and you get massive bounces. It's just that simple. So the charts are screaming buy. The charts are screaming oversold like you wouldn't believe on pretty much everything. It doesn't matter where you look. GDX, $26 support, major support. It fell below, closed below. This again is on the weekly. But again, the technicals are screaming that this was an oversold condition. Anytime you have confluence of these oversold levels in the past, you have gotten a major rally. Look, there's so much confluence in the indicators, okay, market-wide. Again, you can go on to equity by equity by equity by equity by equity, and you get the same thing. Look at Agnico Eagle here. You have to go all the way back to 2015 to get this kind of confluence. Look at this. And when you did, look what happened. Once again, it's just a major, major, major break. And so I think we're coming to that point now. I'm actually very confident to continue to buy gold and silver at these levels. In fact, some of the smaller names, the more speculative 10 baggers and 20 baggers that you'll get from some of the newsletters, these things are up 20%, 50%. And it's not just a few of them. It's a lot of them, okay? And they're up this much since last week when we first got all these buy indicators. And so while we've been watching all of these big names to try to find the bottom and the momentum in the sectors, right? We've been looking for all this kind of confluence. It looks like the names that have the most gains in their future, right? The home run hitters, those are getting bid already. And so while they sold off the most, it looks like they're starting to get the earliest bids. And this could be an indication that we are coming to this bottom. So we need to talk about IPI. IPI was one of the bigger trades for us. We got in at 52. We sold at 108. That was an easy target to call. We had talked about it. I advised everyone to get both in and out. And then after getting out and taking our profits, we looked for re-entry for the long term. And we tried to get back in here at $52. I did myself, and it has now fallen all the way to $40. And so this is down 21%, which is not insignificant. I did sell. Personally, I got out about $48. I took a loss on this because the selling pressure was so great. I just saw it collapsing and I got out. So it took away some of the gains we had made on the run up, but still net positive on the trade, but still getting in here was a loser. It was a bad call. However, it is trying to catch here to ride this 200. It is something worth watching. I think long term, this is still a good company to keep your eye on. But again, it's kind of suffering the same things other commodities are right now. It's a lack of interest in a narrative that the prices they need to fall because of recession and all kinds of nonsense. In the end, we will be vindicated for buying these things on the cheap. But for now, buying at 52 ended up being a little too early to get back in on this. So for those of you who may still be in this trade or thinking about this trade, I think the obvious answer right now is to hold on and wait. Let's zoom out and look at the monthly, actually. Oh, man, see, look at that. That was a double confluence right there. That's a pretty strong level. If it can close above that, I mean, that could look pretty good. We'll keep an eye on that. But for right now, just hold tight. This is a good spot for a potential rally. Let's see. Yeah, I mean, I wouldn't be buying here. I would just be waiting to let it play out. We're just kind of taking ownership for the bad calls. You can't get them all right, and you got to own up to the ones that you don't. So look, the broad market's trying to break out of this descending wedge here, and it managed to get above the 50 on the daily. It sold back down, but it closed above. So if you're bullish broad markets, then that's a good sign for now. Again, it's the same story with volume. There's nothing exceptional about it, but it's not low either. It's pretty average. So take what you can get. It's really more about the price itself, and the price did close above a key level. We had talked about this weeks ago, anticipating where the broad market, bear market rally would go. And this is it right here, about 4,200. Because remember, we came to this price because you have a double confluence of the 200 on the daily and the 50 on the weekly. It just stands to reason. It just makes sense that you would have stiff resistance there. That would also give you several more weeks of time to just flush that out and play while macro events play out, and you hit the stiff resistance before you start to roll over. And so it just makes sense to me that we will see that. I think in much the same way we've talked about uranium at the onset of this, a lot of people are going to get shaken around with the back and forth and the mixed signals that the market is giving. I mean, we're having a lot of bad earnings come out for companies like Snap, and even Tesla would have had negative cash flow if they hadn't sold all their Bitcoin. So there's a lot to be really, really worried about in the macro situation and in the broad markets. There's a lot of landmines about to go off as these earnings come, but the broad sector continues to go up. And I think that these kind of mixed signals are going to confuse a lot of people. And, these bear markets hurt for a lot of reasons, and this is one of them. With that being said, until something changes, the momentum clearly is trying to track this 200 on the daily, the 50 on the weekly. You see the same thing really across all the indices. This is simply what you're looking at. If this changes, then we'll adjust. But for now, that is the goal. That is the target. And again, one of the indicators that made it such a no-brainer to call the swing here in the broad indices was seeing key levels like this on major companies like AMD, Intel, TSM. I mean, we looked at these levels and said, this is a clear spot for a short-term, at minimum, rebound. And that's exactly what we got. I mean, in the case of AMD, since that call, it's up 21%. It did not buy, but it was pretty obvious that that was the play to make, right? And in the case of AMD, you're getting resistance here, as you have in the past with the 50, but it technically managed to close above, very similar to the S&P and whatnot, right? And so it stands to reason with the chip still and whatnot, there are catalysts in play that will get this all the way up to that 200 potentially, if not this $100 mark, psychological level. There's convergence there. That'll be a double confluence. Makes sense. You could see this playing out. Maybe the bill fails. There's all kinds of reasons why it could roll over, but there's plenty of reasons why it could make it all the way. And so we'll see how it plays out, but here's why it matters. The bond market is about to catch a bid. It looks that way. But rather than calling bluff on the Fed, the market may simply be running to safety in anticipation of a larger collapse in the market. This is a very possible scenario that we're looking at. And so as yields come down, the market otherwise up to this point may have seen this as bullish, as a sign that the Fed was going to have to capitulate, and so it's risk on. It's possible that bonds get their previous role as a flight to safety. because I do think the market is sniffing out the Fed's bluff, and I do think the market knows that the Fed's going to roll over. In fact, the market is pricing in the Fed doing just that, which is why it is possible that the broad market starts to roll over as bonds catch a bid. Okay, and so the bond market will catch a bid in a way that surprises most of the market, thinking that this would be bullish when it's actually going to be bearish for broad market. Okay, and this in turn stands in confluence. If you look at what's happening with gold, gold is trying so hard to bottom right now. In fact, you can see that nice rounding pattern playing out. Should you get what I'm describing right now, then this will be a catalyst for gold to get a rebound here, as well as silver. A dollar strength, it's had a nice rip here, and you're getting a bit of a shooting star candle. I mean, it's not technically perfect, but it could be effectively the same. We could get some sell-off here for the near term. It's had a nice run, maybe come down, take a break, retest this 103 level. So you'd get a confluence here of a weakening dollar with strengthening gold on the back of perhaps one more leg up in the broad markets before a larger sell-off, at which point the bond market will catch a bid in a flight to safety. This, of course, will be a double catalyst for an epic flight of fear and fundamentals for gold. I can see that playing out quite well, actually. And so despite the potential for things to be changing perhaps in uranium, I just need more time to see and make clarity of this. I think the case for gold and silver is actually growing and getting even stronger. So look, what's the too long, didn't watch, 2 minutes in a nutshell summary of what's going on? First of all, you need to show up tomorrow, Saturday, July 23rd at 7 p.m. Central Time for the first and only gold, silver, precious metals Twitter space, which we host every single Saturday. This will be episode number 3. Last week we had on Jordan Roy Byrne from the Daily Gold as a special guest. This week, tomorrow, we're going to have Don Durrett, and he's going to make an excellent guest. This is your opportunity to get in there, get involved. You can type your questions down below again if you want, but I encourage everyone to show up. It's going to be great, really informative, and the sentiment right now in the gold and silver space is so low. You know, Alex he barely gave away a free ounce of silver. Sentiment was so low. There's just so little interest. And I think that our time spent in these is going to age very well. And the calls we make here are going to age very well too, as sentiment is so low. But beyond that, I think uranium has some changing dynamics here. I think technically nothing has changed, but potentially we could be losing a lot of our momentum in the space. I think uranium is starting to get a little bit more risky for this next leg up. And we're going to have to watch it a lot more closely. I had actually expected a volume break by now. We did not get it this week, but each week that we don't get it, it becomes more and more and more imminent. And so you'll need to be watching it a bit more closely as time goes on, because once this break comes, it's going to be very, very violent. And so whichever way it goes, you can probably follow it for a meaningful duration of time. With that being said, I'm going to stick around in it. I'm going to watch it play out. I'm going to allow the market to do its thing. But again, I will be watching for that spike of volume in your uranium space for clarity on what happens next for the short to medium term. Beyond that, my faith in the gold and silver space couldn't be higher. I think the technicals are screaming by. At the same time, the broad market is really coming to an potential end to its bear market rally. We have a couple 100 points more that we could rally in the S&P. But beyond that, we are probably getting a little longer in the legs here of this bear market rally. Just at the same time, the bond market looks like it wants to catch a bid on the backdrop of everybody really starting to realize that it's game over for the Fed and all these central banks as the sovereign debt crisis comes to a head. I think now more than ever, you need to be prepared. You need to take this seriously, and you need to get some exposure to the things that are going to help you hedge against what's to come. So stay safe out there.